Well, pending congressional approval, looks like Janet Yellen will be the next chairman of the Federal Reserve. The president announced her nomination yesterday, and after listening to remarks, you can tell a lot about the kind of Fed chairman she is likely to be.
The Fed has powerful tools to influence the economy and the financial system, but I believe its greatest strength rests in its capacity to approach important decisions with expertise and objectivity, to vigorously debate diverse views, and then to unite behind its response. The Federal Reserve can help if it does its job effectively. We can help ensure that everyone has the opportunity to work hard and build a better life. We can ensure that inflation remains in check and doesn't undermine the benefits of a growing economy. While we have made progress, we have farther to go. The mandate of the Federal Reserve is to serve all the American people. And too many Americans still can't find a job and worry how they'll pay their bills and provide for their families.
Do you notice the language that she used? Listen a little closer.
The Fed has powerful tools to influence the economy and the financial system. The Federal Reserve can help if it does its job effectively. We can ensure that inflation remains in check. While we have made progress, we have farther to go.
That doesn't sound like a passive Fed chairman to me. Now, while Ms. Yellen is expected to follow Ben Bernanke's playbook, it sounds like she's ready to take action. Economist Martin Feldstein, who used to head the panel that decides the length of U.S. expansions and recessions, he lays out a possible line of action she may take.
One of the things that she can do as head of the Fed is to make it clear that this tapering process is inevitable, and that the only way the economy is going to deal with some of these problems is to remove the kind of uncertainties that hang over consumers, that hang over businesses. And if they can do a deal where they get rid of some of the sequester and the contractionary, the negative effect of that, in exchange for doing some long-term things, that would be a big boost.
Hey, then she could be the president.
Well, PIMCO's Bill Gross, manager of the world's largest bond fund, sees that activism coming through.
If you make the supposition, as we do at PIMCO, that at some point, quantitative easing has to end. I mean, Adam, at some point, if they continue at $1 trillion a year in terms of check writing, they will own a majority of not only treasuries but mortgages and basically corrupt, the private market. And so at some point, they have to get out. What do they get out to? They get out to basically to forward guidance in which the Fed assures private investors that the policy rate will stay, where it is under certain specific conditions. And can she strengthen that, as your question, suggests? I think so. I think the Fed minutes today again suggested that, potentially going forward, they can strengthen it in terms of a higher minimum for inflation, or ultimately, perhaps, in our view, something that's targeted towards nominal GDP. So investors can gain confidence in terms of the Fed doing what it says it's going to do, as they ultimately, define more accurately what those targets will be.
So what does the Yellen pick mean for the bond market, Bill?
Ultimately, it's front-end friendly, meaning that anything that is anchored to the policy rate, and the policy rate being, something that probably is going to be 25 basis points for at least the next several years. I think anything that's anchored to that, will do well and has done well. I think perhaps 10- and 30-year treasuries, which, are subject to inflation and reflation, which is, basically what this policy of Janet Yellen's is going to do, or going to attempt to do, that those particular maturities are probably negatively affected. So bonds, it's bond friendly, but certain bond friendly, put it that way.
Okay, so stick with shorter-term bonds, says Bill Gross. As for stocks, veteran strategist Bob Dahl says just wait till next year.
I don't think we make any forward progress until the noise in Washington calms down. I've been surprised how strong the market has remained until the last couple of days anyway. with that staring us in the face. Then the next big thing is third quarter earnings. We're getting them fast and furious, and the consensus is looking for a whopping 2 to 3% growth rate in earnings. That's not the stuff of a bull market. If we're not going to get PE improvement and the environment doesn't encourage that, and that's all earnings are going to grow, I think we're in this consolidation period. I've used 1550 to 1700 on the S&P 500. We've been there for 6 months. I'm not sure that ends anytime soon.
Would you take money off the table here then?
No, I don't see downside either. Consolidation to me means sidewise chop, not necessarily downside. So I want to be in equities. I think they'll do better again next year because I think we'll get a slightly better economy if we get out of our own way. DC, thank you.
And it's not just investors adding up change at the world's most powerful central bank. Global leaders at the IMF World Bank annual meetings in Washington are watching very closely, like the former head of Germany's central bank.
The big feature of this year has been a normalization of the world economy. The U.S. is taking again the cyclical lead position in the recovery. Emerging markets have come down quite a bit, so they're not leading growth globally. They're kind of lagging it at the moment, which used to be the average picture. And Europe is somewhere in the middle, trying to come out of a deep crisis. And the central banks played a key role in that. I see it as a sign of continuity. Janet Yellen was a trademark name in economics. She was a trademark name in central banking, very experienced, years of experience during the crisis. What will be more important in central banking will be committee views. I think the Fed is moving towards that. The ECB has clearly moved to that. So what matters is much less the personal view of the one person at the helm of the bank, but more where the committee sees the economy. And the Fed has moved to a communication that puts the committee at the core. Look at their projections where interest rates will be in the years going forward. The consensus view, where most of the people think interest rates will be, is a good guidance for markets.